Okay, we'll go ahead and get started then. And welcome to our webinar today entitled Unraveling the Mystery of 1031 Exchange Transactions. And we're often asked, why do we name it that? We get people who call us and say things like, I've called and talked to 3 or 4 people. I got 3 or 4 different answers. I'm really confused as to what really matters, what really qualifies. So our objective today is to kind of go through all of the requirements for a 1031 exchange transaction. We're going to cover all the basic requirements. We will go into some of the intermediate and even 1 or 2 advanced requirements just to kind of point out issues. But as we're going through the process, we'll point out the areas where there's the most confusion and what really matters so that you have enough information to make a better informed investment decision. What it often boils down to is people give opinions, and the opinions are probably all right, but they're all different. And so it gets confusing as to, well, what really matters? So that's the objective as we go through the program today, is just to make sure we point those out, answer the questions, and that way you'll know what really matters and you can decide what's right for you. So that's the most important part. We are going to take questions as we go, so please use the question box on the console. Just type in your question. I'll try to track those as we're going through the presentation today. I'll answer them as we go, and if it doesn't come into one of the slides that we're going to cover, we'll answer the questions at the very end. And we'll have time at the end as well just to hang out, and if you want to ask questions, brainstorm, happy to do that as well. The QR code there will allow you to download our guidebook and some of our other brochures and my contact information, so feel free to do that. And with that, we will go ahead and we will get started. So again, it's unraveling the mystery of 1031 exchanges. That's our objective, is to kind of walk through all of that. First, for just a little introduction for those of you who have not worked with us before, Exeter 1031 Exchange Services is the qualified intermediary, or also referred to as accommodator or facilitator, etc. We administer all types of 1031 exchanges. We cover all 50 states. We're one of the few qualified intermediaries that also does the U.S. territories and also foreign properties. So that's one of the first areas that we'll point out. If you're looking on websites, brochures, and things like that, it will say things like you cannot exchange foreign property. What they really mean is you cannot sell US-based property and 1031 exchange into foreign-based property, or vice versa. You can't sell foreign property and exchange into US property. It's not considered like kind. However, you can sell foreign property that's held for rental, investment, or business use and exchange into other foreign property that's also held for rental, investment, or business use. So they're really telling you you can't go US to foreign or foreign to US, but they don't mean you can't exchange foreign property. If you're exchanging out of foreign property into foreign property, and that is going to trigger a US tax consequence, the 1031 exchange will defer the US tax consequence. So you can 1031 exchange foreign property as long as you're exchanging for other foreign property. We also serve as an exchange accommodation title holder. That's when we have to acquire and hold legal title. It's what the IRS calls parking title to the property as part of a reverse 1031 exchange or an improvement 1031 exchange. So really, we handle all types of exchanges, no matter what that is. We are one of the few qualified intermediaries that has any kind of government or regulatory oversight. We're going to talk more about that in a minute. We've administered 1031 exchanges now. Personally, this is my 40th year, but as a company, it's our 20th year. In fact, this last Sunday was our 20th anniversary. So we've been doing this for a long time. We've done a lot of interesting exchanges over the years. So that's one of the things you get with working with us, is we've got a long track record of doing lots of different types of exchanges. We are more consultative and advisory in nature. We work with you and your advisors so that you get kind of our expertise on the 1031 exchange side, but you also work with your tax advisors, your legal advisors, your investment and financial advisors to make sure you're doing the right thing for you. And whatever really will achieve your goals and objectives is most important. So We certainly have the answers. We've been doing this a long time. Feel free to reach out, ask questions. We also have 24/7 access, so people get questions all the time at night, after hours, weekends, what have you. You can always get one of us. I mentioned we're one of the few qualified intermediaries that has any kind of regulatory oversight. Our industry, this is important to note, our industry has no licensing or regulatory bodies to govern or oversee the industry. We wanted to be regulated, and since there is no body to do so, we decided to go down the banking path. And what we've done is we took a couple of years of going through the review, the audit, and the approval process to get our own trust company charter. So that was the result of this is Exeter Trust Company. So Exeter Trust Company is headquartered in Cheyenne, Wyoming. It is licensed, regulated, and audited by the Wyoming Division of Banking. Because of that, it has the usual fidelity bond coverage, errors and omissions, insurance coverage, but we also have the fiduciary insurance or the financial institution blanket bond coverage because we are a trust company or financial institution. And that's critical when it comes to protecting you and your 1031 exchange funds. That also gave us the ability to roll out other products. So the trust company actually serves as trustee of the 1031 exchange qualified trust account. We're going to go into more detail as to why that is important. But all of the funds are held in separate, segregated, dual signature qualified trust accounts. We also launched other products since we're now a trust company. So we offer self-directed IRAs and self-directed individual 401k plans. And that's when individuals want to use their IRAs or their 401k plans to invest in non-traditional investments, often referred to as alternative assets. That would be things like real estate, deeds of trust, mortgages, tax lien certificates, etc., privately held companies, LLCs, limited partnerships, and many other types of non-traditional assets that you can actually purchase inside of your IRA as an investment. So we are the IRA custodian. We also offer title holding trusts or land trusts. So for individuals who want to negotiate, acquire, and hold real estate in a confidential manner, we can do that through the title holding trust. We don't want to compete with escrow companies or title companies, so we don't do traditional escrows. But when there's a specialty holding escrow need where the title company and the escrow company are not permitted to do that because of their regulatory requirements, we could certainly take a look at that and see if it can help, or if we can help. And then we do all sorts of general custody accounts as well. So with that, let's kind of jump into the topic. And again, as we go, if you have questions, please feel free to type the questions in the Q&A or the question box, and we'll do our best to answer all of your questions. It doesn't matter how basic or how complicated or advanced the question is, we'll take all of them. So for those who are really brand new to the concept, this is a 1031 exchange. It's a tax deferred exchange of real estate. It's named 1031 under the section of the tax code, section 1031, which is what creates it. It's all about deferring the tax, keeping the money in your pocket, etc., when you sell real estate, because the sale of real estate is going to likely trigger various taxes, capital gain taxes, depreciation recapture taxes, etc. And it's all about deferring those taxes. Before we go too far into that, I wanted to give a little history because this is kind of a fun topic. You know, for those of you who've been around as long as I have, you've probably heard the term Starker exchange or Starker 1031 exchange, and you wonder, well, where does this word Starker come from? So 1031 exchanges have been around since 1921. So this is coming up on the 103rd year anniversary of 1031 exchanges. And if you go back, way back, you know, before the 1960s, the exchanges were all concurrent. So you'd close on the sale of your current property and close on the purchase of the new property, all on a concurrent same-day basis. Well, as you can imagine, that creates lots of complexities trying to get everything to record on the exact same day. It's very difficult. So there's a family by the name of Starker, and in the 60s, the Starker family did an exchange transaction with Crown Zellerbach Corporation. And what they did effectively is said, look, we're going to sell you our timberland to Crown Zellerbach, and Crown Zellerbach in return, we're going to tell you or identify the properties that we want in return. and you're going to go out and buy those for us and then give us the property. So they gave up their property to Crown Zellerbach, and in return, they identified property which Crown Zellerbach purchased and gave to them. And they had a 5-year commitment. Crown Zellerbach had to acquire this property and convey it to them within a 5-year period. So when you think about that, that's a 5-year delayed exchange. So that created all sorts of issues. The IRS, of course, audited the Starker family. They disallowed the 1031 exchange transactions that they did. The Starker family decided to fight that. The cases went all the way to tax court and were wrapped up in the late 1970s. And for the most part, they won on all issues except for 1 or 2. So the Starker family really set the precedent for today's delayed 1031 exchange. So that's why you'll hear people still today call it a Starker exchange. It's after the Starker family. Then I thought we'd kind of real quick cover some of the legislative changes, both in the last, say, 5 years or so. The Tax Reform Act of 2017 changed a lot of things, although it didn't really have any impact on real estate 1031 exchanges. Now, pre-2018, so before the Tax Act of 2017 came into being, you could actually do 1031 exchanges of personal property. So shipping, trucking, livestock, equipment, anything that was actually held for rental, investment, or business use, even if it was not real estate. Airplanes, for example, could be exchanged for other like-kind properties. So if you're selling aircraft, you could buy aircraft. That was taken away in the 2017 Tax Act. So the only thing we could do 1031 exchanges on today is real estate. So just want to point that out, that personal property, which is non-real estate, no longer qualifies for 1031 exchange treatment. The Tax Reform Act of 2017 also rolled out a new tax planning, tax deferred strategy called the Qualified Opportunity Zone. And that actually is a different animal. It's really not, it doesn't work with a 1031 exchange. And the reason for that is these Qualified Opportunity Zone funds are typically set up as LLCs. You buy into the LLC, you become a member in the LLC, which means you are now a partner in a partnership. It's an LLC partnership. And with that, you now own whatever's inside of the LLC or the partnership. Well, you're a partner in a partnership, and that doesn't qualify for 1031 exchange treatment because you're buying a partnership interest. So they don't work with a 1031 exchange. However, it could be a great way to save a failed 1031 exchange. So if you've sold your property, you're in the middle of a 1031 exchange, and for whatever reason you can't find or locate or even close on properties to complete your 1031 exchange, you could look at a Qualified Opportunity Zone fund as a backup strategy to allow you to defer the current tax for a couple of years. And the big benefit there is the new investment inside the Qualified Opportunity Zone is tax-free after you've held it for 10 years. So the current tax will be due December 31st, 2026. A lot of the Qualified Opportunity Zone fund sponsors are planning a cash out refinance to help provide cash to pay the taxes with, and the new investment is tax-free. So that's really the big benefit there. It also rolled out bonus depreciation, Section 179 depreciation, expanded some of those programs, etc. The one we're getting a lot of questions on today are the current proposals from the Biden administration. And the Biden administration started proposing in 2021 and then again in 2022, 2023, and again in 2024 to limit or restrict the amount of capital gain that you can defer through a 1031 exchange transaction. And you've probably heard about this if you're, read up on these things. The proposal is to limit the amount of gain that any one taxpayer can defer to no more than $500,000 per year per taxpayer. So a married couple could defer $1 million per year of capital gain tax. Now, none of that ever went anywhere. In 21 through 23, they never went anywhere. In 24, we don't think that's going to go anywhere. Congress is too divided. And of course, it's an election year, so nobody wants to rock the boat. But the one warning here is 2025 is right behind us. 2025 is where a lot of the Tax Reform Act of 2017's components are going to sunset or revert back to 2017 levels. That means everything is going to be on the table to help pay for all the changes that are probably going to come. So keep your eyes open. 1031 exchanges will probably be one of those items, like they always are, as in terms of proposing to eliminate them or restrict them. And we'll need all hands on deck to help fight the fight, because 1031 exchanges are an incredibly valuable tool, as you know. And there's been a number of studies that have shown that the national GDP would drop by a very large percent if 1031 exchanges were taken away. So it would have a material impact on the economy. So more to come on that. We'll actually do some webinars and presentations on the status of that as we go through 2025. The Federation of Exchange Accommodators have already gone back to DC back in April to start educating members of Congress, especially the House Ways and Means Committee members, as to how a 1031 works, what the benefits are, et cetera. So we're already working on educating them on why they should not touch 1031 exchanges. Having said all of that, let's jump right into our topic, and that is 1031 exchanges. We get a lot of questions on, should I do a 1031? Should I not do a 1031? So those are great questions. It's my favorite answer. It depends on your situation. So a lot of people use 1031 exchanges to either diversify, consolidate, or reposition their investment real estate. Diversification, if you're a brand new investor, you probably have one single family home as a rental property. And if you really like the rental property business, you might say, I'm ready for a duplex or a fourplex or what have you. Or you might say, I want to diversify. I don't want one asset in one city. I'm going to sell the one asset and buy 2 or 3 different assets in different geographic locations. Or you might diversify by asset class. Maybe you buy a single family, maybe you buy multifamily, and maybe you buy something else, a storage facility or something like that. So you'd have different types of assets. So diversification means many things depending on what is right for you and your goals and objectives. Consolidation is the opposite, where typically you see that as folks get closer to retirement or into retirement and they're tired of the property management headaches, the labor intensive issues, the phone calls where the toilet overflowed and things like that. So they sell multiple properties, 2 or 3 or 4 properties, in exchange into one property that is easier to manage, has less labor intensive, responsibilities, et cetera. So that's a consolidation strategy. You also see that where you get a lot of people who have acquired a bunch of single family homes or a bunch of duplexes, and now they want one large multifamily property. So you consolidate all the smaller properties into one larger multifamily property that has everything obviously at one location. It's easier to manage because it's all right there. You get the economies of scale and what have you. Or you get people who are looking at the economy and saying, I want to reposition my portfolio based on where I think the next, say, 10 years are going to go. So they start to reposition their portfolio, getting ready for the next economic trend that might be coming down the road. All of these can be done or through a 1031 exchange, so you don't have to pay taxes. You defer your capital gain tax, your depreciation recapture tax. You avoid the net investment income tax, or what people call the Obamacare tax, because if you had to pay tax, it's very, very cost prohibitive. You're going to cut a check for anywhere from 30 to maybe upward of 40% of your profit, depending on what state you're located in. And it's very difficult to reinvest if you lose a big chunk of your equity there. So also keep in mind that when you're doing a 1031 exchange, it should put you in a better position, and only you can define what that means. Are you looking to diversify, consolidate, reposition? Are you looking to get out of a Class C property, go into a Class A property? Is the neighborhood bad? In California here, we're having lots of legislative actions and rent controls and eviction moratoriums and things. So people are getting out of California because it's just not landlord friendly. So there's lots of reasons, but only you can define what will put you in a better position. If it's not going to put you in a better position, you probably shouldn't be doing it. So having said that, what's the real benefit of a 1031 exchange? And it's all about income tax consequences. So When you're selling real estate, it's probably going to trigger a capital gain tax and probably trigger a depreciation recapture, etc. If you do nothing, if you just sell it, it's going to trigger those taxes, and that can be very expensive, very painful. But they can be deferred or excluded depending on your goals and objectives and proper planning in which part of the tax code that you're going to be using. So keep in mind, it's a tax deferred structure. It's not a tax-free structure, but it can become tax-free. We're going to show you how that would work. The bottom line is it keeps all of your money in your pocket. Instead of paying federal taxes and state taxes, it keeps all of the money in your pocket. So you get all of your equity to reinvest, which makes it easier to buy larger properties, more units, increase your cash flow, and ultimately increase your net worth. So that's really what it's all about. We have one question, is a qualified opportunity zone the same as a DST? No, they're actually very different. The sponsors that do the Delaware Statutory Trust, or DST, often offer a qualified opportunity zone option as well, but they're different animals altogether. So a Delaware Statutory Trust is a trust. They call it Delaware because it's written under Delaware law, but it's just a trust that will buy very large assets. Most of the Delaware Statutory Trusts are going to be 50 million to maybe upward of 250 million. And there is a specific IRS ruling that allows the investor to identify a percentage of that trust. And usually it's going to be like a 0.25% interest, where you identify that as part of your 1031 exchange. You purchase a 0.25% interest in the Delaware Statutory Trust. That's considered a purchase of investment real estate, and it qualifies for 1031 exchange treatment. So that certainly works and satisfies the 1031 exchange requirements. The qualified opportunity zone is structured differently. So it's actually a partnership. And, I shouldn't say it's always, but in most cases, it's an LLC that's set up to do this. You buy into the LLC, you become a member. It's treated as a partnership for tax purposes. So you're also considered a partner in a partnership. And purchasing a partnership interest does not work with the 1031 exchange. So very different animals with different goals and objectives from a tax perspective. Okay, so going back to kind of why would you do a 1031 exchange, et cetera. Obviously, it's tax deferred. You're keeping the equity in your pocket. There's huge benefits for doing that, and it's all about the tax deferral ability. But people forget that it's more than just a tax deferred strategy. It's really a wealth building tool. You keep exchanging over your lifetime. So every time you sell rental, investment, or business use property, you do an exchange. You exchange into the next property. In most cases, people trade up in value. So if you own a single family, maybe you buy a duplex. 5 years later, you sell the duplex, you buy a fourplex, or what have you. And each time you do that, you put yourself in a better position. You increase the number of units, you increase your cash flow, you diversify, whatever is right for you, but it keeps putting you in a better position, and it keeps the wealth in your family. So instead of writing a check to the feds and the state for taxes, it keeps it in your pocket. Now, the best way in most cases to take advantage of the 1031 exchange is you keep exchanging until you pass on. When you pass on, you leave the property to whomever you choose, your kids, your grandkids, friends, family, whatever. When you do that, whoever you leave the property to is going to get a step up in cost basis. So that means the capital gain tax goes away, the depreciation recapture tax goes away, you avoid the net investment income tax or the Obamacare tax of 3.8%, et cetera. The reason you get to do that is the value of that property when you pass is included in your estate plan, or estate value, if you will. So they're going to calculate estate tax based on the value of your estate upon death. So they cannot also tax you on capital gain taxes. So since it's part of the estate tax computation, they can't charge you capital gain tax. So the person who inherits the property gets a step up in cost basis. So as a quick example, let's say years ago you bought property, it's worth $100,000. It's gone up in value. Let's say today, years and years or decades later, let's say it's worth $5 million, and you pass. And let's say you leave it to your kids. Your kids will inherit that property. your kid's cost basis is going to be stepped up or increased to the fair market value at the date of your death. So that means their cost basis is increased to $5 million. They could sell it the next day for $5 million. Their cost basis is $5 million. They pay zero taxes. So with that in mind, the step up in cost basis is typically the best way to go. But you may have other goals and objectives, et cetera. So it really depends, again, on what's right for you. So the best way to remember all of this, we have a morbid sense of humor. We call it swap until you drop. Keep exchanging until you pass, and then you get that step up in cost basis. Okay, real quick, I wanted to go over a number of different tax planning opportunities because the 1031 exchange is usually the right choice for you, but not always. So I want to quickly cover these. 1031 exchanges, of course, apply to properties held for rental, investment, or business use. It does not apply to property held for personal use. So a primary residence, a second home, or a vacation home used for personal family use is not going to qualify, although it could. You can always change the usage. The 1033 is one that a lot of people have not heard of. 1033 exchanges come into play in two scenarios. One is natural disaster, fire, flood, hurricane, tornado, etc., where the property is fully or partially destroyed. You submit a claim to your insurance company. They, issue you a claim check. You receive the proceeds from the insurance company, and typically you use the money to rebuild or repair the property that was partially or fully destroyed. That's actually a 1033 exchange. You've received proceeds from effectively a sale, if you will, and you've reinvested by rebuilding the property. So that's a 1033 exchange. Most people don't realize that. Most people don't report it as a 1031 exchange, but it is a 1033 exchange. Not 1031, 1033. The reason I like to bring it up is when the government could get involved. So it could be a condemnation, or technically it's an eminent domain. Both of these are considered involuntary conversions. You didn't want it to happen, it just happened. So when the government is taking your property, it's an eminent domain. They're going to tell you what the property's worth. They're going to give you a check. You can also fight that. But when you receive the check, those are sale proceeds. You've sold the property to the government, even though it wasn't your choice. That's a taxable event. So you can take the cash and you can reinvest in other like-kind property and defer the payment of those taxes through a 1033 exchange transaction. Now, why do I bring it up? Well, the reason I like it is you might be doing a regular sale and negotiating with a government agency to sell the property to them, and it may not be an involuntary conversion. They may not be doing anything like an eminent domain. It's just a regular negotiation. But you can ask the government agency if they have eminent domain authority to threaten you or actually do eminent domain. So all it has to do is go into the contract and say, if you fail to sell, if you fail to close on the sale to us, we will take the property from you through eminent domain. Or they could put it on letterhead. If you fail to sell this property, our intention is to take the property from you. It has to be an actual threat or an actual taking, but then you qualify for 1033 exchange treatment. Lots of planning opportunities here. The 1033 exchange does not have any requirement. In fact, there's no ability to actually have somebody like us hold the funds. You don't need a qualified intermediary or anything like that. So you can take the cash, you can do whatever you want to do with it. You can put it in your checking account, you can reinvest it some other place. As long as you reinvest in like-kind replacement property within the time frame, and it depends on which subsection of the code you fall under, but this reinvestment period could be anywhere from 2 to 5 years, gives you a much longer time frame than a 1031 exchange to reinvest, and you don't have to reinvest the cash. So let's say you had a $1 million asset taken from you through eminent domain. As long as you bought a property for $1 million or greater, it doesn't matter how you paid for it. It doesn't matter if it's all cash. It doesn't matter if it's all debt or a combination. It doesn't matter if you use the cash that you received, as long as you trade equal or up in value. So a lot of planning opportunities there. The rest of these I'm going to go through fairly quickly. So a 1031 exchange was the old rollover provision of your primary residence. So before 1997, if you had a primary residence, you sold it, you rolled it over and reinvested within 2 years in a property of equal or greater value, you rolled over your capital gain. It was a tax deferred exchange, and you rolled over the entire gain. That was taken away from us. That was replaced with the 121 exclusion, so section 121 of the tax code. And today we have an exclusion, which is tax-free, not tax deferred. So if you sell your primary residence and you can say you've lived in it for 2 out of the last 5 years, you get up to $250,000 tax-free per person. So if you're a married couple, you get $500,000 tax-free as long as you can satisfy that 2 out of the last 5-year test. There is a way to combine that with the 1031 exchange. We'll show you that at the end of the presentation. 453 or section 453 of the tax code involves a promissory note, a seller carryback note or seller carryback financing. We're going to talk more about that later because that complicates a 1031 exchange. Contrary to what you have seen out there on the internet where they say you can't do a seller carryback and a 1031 exchange together, that is not correct. You can. There are ways to do it. We're going to give you 5 options, but it does complicate your 1031 exchange. So my advice is try to avoid a seller carryback note if you can. Although in today's market, we realize that it's complicated and people are doing seller carryback notes just to get deals done. Next is the 721 exchange. It's becoming more common. You hear about it a little more frequently. Most people call and say, can I buy or can I 1031 exchange into a REIT? The answer is no. A REIT is a real estate investment trust. It's considered a security, just like stocks and bonds and mutual funds. And that doesn't qualify as real estate. Even though the REIT holds real estate, the REIT itself is a security. But there is a way to do that through an exception, and it's called different things. Some people call it a 721 exchange. Some call it an UP-REIT. The UP part, the UP stands for Umbrella Partnership Real Estate Investment Trust, or people call it a 1031/721 exchange. Very short version of that, you sell, you do an exchange, you identify a fractional interest in a large property that the REIT has put together, you buy into that, usually 1/4% or 1%, whatever your position would be. You hold it for a couple of years to show your intent to hold for investment. That's the 1031 exchange portion. Then after that holding period, it's contributed, the entire property is contributed into the umbrella partnership. Now you're part of the REIT. That's the 721 contribution portion of the transaction. There's benefits. You're part of the REIT. You get the cash flow of the REIT, the diversification of the REIT. There's 2 negatives, or at least one that's a big negative. One may or may not be a negative. The first negative is now you own a security, so you can no longer 1031 exchange again. Now, some people don't care. That's not a negative. Other people go, oh my gosh, nobody told me that. So keep that in mind. The second one is when you're in that umbrella partnership, if the sponsor decides to sell that property, that's going to trigger your capital gain tax without your authorization. So be very careful when you're going into these. Read the private placement memorandums. Make sure you understand when or if that could be done. Cost segregation analysis, of course, allow you to take the property, break it down into component parts. A good example is a hotel, and you break your lighting down and your various fixtures, etc., landscaping. You break it down into parts where you can depreciate a lot faster than the typical 27.5 or 39-year depreciation schedule. So it gives you a better, larger tax deduction early on. So you might not even pay taxes for the first 5, maybe 7 years while you're taking advantage of the cost segregation. And there's certainly other options, so always make sure you talk to your tax advisor to see if there's something else out there. Okay, having said that, let's move on, and this is where we really get into details on the 1031 exchange transaction. There's really 3 component parts. There's a forward 1031 exchange, there's a reverse 1031 exchange, and there's an improvement 1031 exchange. I guess component parts is probably not the right wording. It's 3 different structures, and then there's variations off of each of these. So the forward exchange is where you are selling first, and then you reinvest and buy your replacement property second. The reverse exchange is the opposite. You are buying your replacement property first. You're actually closing on the purchase of your new replacement property, and then you're selling your current property, your relinquished property later. That does a lot of benefits in today's market because this market is a tough market. finding replacement property is really difficult. So the ability to go out, spend all the time you want to look for property without a deadline, find the right property, do your due diligence, and then actually end up closing on the purchase of your new property so you know you've got it, eliminates a lot of the risk in the 1031 exchange today. Having said that, they're a lot more complicated. The qualified intermediary is required to acquire and hold, or what the IRS calls park legal title to the replacement property, or in some cases, the relinquished property. And lenders, traditional lenders, typically don't like that. They won't touch it. So it complicates the transaction. There's more moving parts, more coordination involved. So bottom line there is if you have the ability to do that, it could be a great strategy in difficult markets like today, but it does complicate the process quite a bit. So having said that, if you want more information on a reverse exchange, we've got a couple reverse exchange webinars coming up that we can talk about that in more detail, or you just give us a call. We'll walk through your scenario and see if it's a good fit. Improvement 1031 exchanges, or what a lot of people refer to as build-to-suit exchanges or construction exchanges, are difficult. You've got a safe harbor rule that requires you to do everything within 6 months, or exactly 180 calendar days. Identifying replacement property, acquiring the property, and us then having to hold title to the property just like a reverse exchange or parking title, and then first then getting permits, etc., and then making the improvements and getting all of that done within 180 calendar days is very difficult. You don't have to be completely done. It's possible to do kind of part of the improvements, etc., but it's very difficult, especially in certain states. The permitting process can take forever. So you don't see a whole lot of those because it is just a lot more challenging. Getting started, make sure you notify all the parties that you're going to be doing a 1031 exchange. Involve your legal, tax, financial, and investment advisors, especially your tax advisor. There might be reasons why you don't want to do a 1031 exchange. We're going to talk about partial exchanges later. Your tax advisor can help you decide if a partial 1031 exchange could work for you. Talk to the qualified intermediary. Hopefully you choose us. We'd love to work with you. We'll walk through the process, see if there's any issues, if we identify any problems, etc. Make sure the closing agent is aware of that, because their documents get drafted a little differently and they're going to have to redo everything if you don't tell them in advance. So be very careful that you notify the parties so they know what's coming. Okay, mechanical steps. So number one, once you've hired your qualified intermediary, it's very important that the 1031 exchange be set up and in place before closing. Part of the process in part of the documentation involves the assignment of your purchase and sale agreement. So that document is converted over to us. We step into your shoes. We become the seller of your property, and that's what allows you to defer the tax. If the closing occurs without the 1031 exchange in place and without that assignment of the purchase and sale agreement, it becomes taxable, and there's no way to go back and fix that. And we literally get calls every week that say I closed yesterday or last week or what have you. They'll even say, well, don't worry, I told the closing agent don't disperse the money because I'm going to do a 1031 exchange. Unfortunately, the minute it closes with you listed as the seller, you have the right to receive the funds. So even if you told closing agents not to disperse the funds, you have the right to the funds, and unfortunately, it becomes a taxable event. So the qualified intermediary really does three things. We draft the legal documents to structure the 1031 exchange. We're going to hold the equity, the cash, from the sale until you're ready to do the closing the purchase, or we're going to hold legal title to real estate if it's a reverse 1031 exchange. And then we really serve as in a consultative capacity where we can work with you and your advisors to answer questions, solve problems, things like that. One of the things that nobody ever seems to mention or bring up in presentations, and I think it's critical, is how do you safeguard your funds? Qualified intermediaries hold a lot of money for a lot of different clients. And as I mentioned before, our industry does not have any licensing or regulatory capabilities. So there's no licensing, there's no regulatory oversight in our industry. So very few qualified intermediaries have any regulatory body overseeing them unless they've gone down a different path. To me, that is critical. I've been in the business now 40 years. I've seen a lot of qualified intermediaries fail over the years. Most of them would have been prevented had there been government oversight. So that oversight is critical. We decided a number of years ago that we wanted to be regulated. We went down a couple of year path where we got evaluated, interviewed, audited, etc., and we're able to get our own trust company charter. So the result, as I said, was Exeter Trust Company. So Exeter 1031 Exchange is the qualified intermediary. Exeter Trust Company is the regulated entity that actually holds the funds on behalf of the client. That means the funds are held in a regulated body. It's licensed, it's audited every year to make sure we're operating in a safe and sound manner, etc. So to me, these are the three most important components when you're reviewing a qualified intermediary. Do they have any government or regulatory oversight or licensing of any kind? Most do not. It's critical that somebody's watching over their shoulder. Number two, everybody's human, everyone's going to make mistakes. You need to make sure they have the adequate insurance. Do they have fidelity bond coverage, which is crime insurance? Do they have errors and omissions insurance? So if they make a mistake, they're covered, or you're covered, I should say. Or do they have a financial institution blanket bond if they're a bank, trust company, etc.? Those are critical questions to make sure that you're protected. And finally, make sure that they're using a qualified trust account or a qualified escrow account. That's one of the big reasons we set up Exeter Trust Company, so that we are holding the funds in separate, segregated, dual signature qualified trust accounts to protect you. In the Land America failure in 2008-2009, the judge ruled that the funds were corporate funds, not client trust funds, because the funds were held in their corporate name. That works from a 1031 exchange perspective, but it doesn't protect you. And that's why we set up the trust company. In our case, if something were to happen to us, another 2008 recession or another COVID or something like that, and we didn't make it through that whole process, the funds are clearly held as client trust funds in a trust company, so you are protected. Second with that, some of the folks on the call today are licensed real estate agents. The way to protect yourself is if your client is working with rental, investment, or business use property, send them an email and say, look, you're talking about selling or buying rental, investment, or business use property. Have you spoken to someone about a 1031 exchange? Have you talked to your tax advisor? Make sure that you've at least put that out there. We do a lot of expert witness work, and attorneys more frequently now are calling up and saying, my client sold, had to pay tax, nobody told them about a 1031 exchange, and they did reinvest. Whose fault is it? Well, clearly the investors should have gone to their CPA or their tax advisor, and that would have prevented the whole problem. But a lot of times they don't, and if they don't, they want to blame other people for what went wrong. So always make sure you bring that up just to protect yourself. Okay, qualifying use. This is probably the most important slide in the slide deck. It's the area where there is the most confusion. It's the area where you get the most opinions out there that differ. And this is where people call and say, look, I spoke to 3 or 4 people, I got 3 or 4 different answers, and I don't even know what qualifies. I mean, I don't know where to start. This is also where people get hung up on how long did you hold title to the property. So we'll get people who call us and say, I was told that I don't qualify for a 1031 exchange because I didn't hold the property for at least 1 year, 1 year and a day, 18 months, 24 months. Well, what is it? How long do I have to hold title to the property? So the big thing here is it doesn't matter. There's nothing in the tax code or the regulations that say you have to hold title or own the property for at least a year or 2 years or what have you. What it does say is you have to have the intent to hold for rental, investment, or business use. So what it really boils down to is if you get audited, can you show that you had the intent to hold for investment purposes? Now, the longer you hold the property as rental or as investment or as business use, the easier it is to prove intent. That's why people get hung up on the length of time. But the length of time really doesn't matter. So it boils down to if you hold title or own the property as rental, so some type of cash flow, rental agreements, lease agreements, etc., it qualifies. It doesn't have to produce cash flow. So a lot of the things out there on the internet say you have to hold the property as rental property. Not necessarily. You could buy the property and you can hold it as an investment for capital appreciation. It doesn't have to produce cash flow. So some people will go out and buy land or dirt and just hold it for capital appreciation. That qualifies. Or you could buy property to use in your business. That would also qualify. Now, property held for sale does not qualify. That's where it gets interesting. This is where there's a lot of confusion. So again, it boils down to your intent. If you are in the business of buying property and doing something to the property and then selling it right after you finish that, you're holding for sale, you're not holding for investment. So examples, builders, developers, and contractors, they'll typically buy the property, build it out or rehab it, and then sell it. So they're holding for sale, they're not holding for investment. They don't qualify for 1031 exchange treatment. Rehabbers, flippers, whatever you want to call them, they buy property, they rehab the property, and they sell it. So they're holding for sale, they're not holding for investment purposes. Condo conversion specialists, they buy multifamily property, they convert to condos, and they sell. So all of those folks buy, do something, and sell. They're holding for sale like inventory in their real estate business, and it doesn't qualify for 1031 exchange treatment. Now, if any of those folks were to buy, do something to the property, and then hold it as rental or investment property, it would qualify. So again, it boils down to your intent. So a couple of examples, there's 2 tax court cases, both were developers, both bought dirt, both intended to build and then sell. Neither one built anything. One held the dirt for 12 years, one held the dirt for 20 years. Both ended up selling, both did 1031 exchanges, both got audited, and both were disqualified. It shocked everybody because 12 and 20 years is a very long-term hold, but their intent was to buy, build, and sell. So the length of time didn't save them. Now, somewhere along the way there, had their intent changed, maybe their business changed, the real estate market changed, COVID-19 changed a lot of things for a lot of people. Had they changed their intent and said, now I'm going to hold these for capital appreciation, and they changed the way they reported it on investment documents, financial statements, loan applications, and most importantly, their tax returns, Schedule E, showing it as held for rental, investment, or business use instead of held for development, their exchanges would have qualified. On the flip side, we have one of our clients a long time ago, sell, do an exchange, bought a condo, didn't read the CC&Rs until after closing, quickly found out within a couple of weeks or so, maybe a couple of days, that it had to be owner occupied. It could not be held for rental or investment purposes. He quickly sold at another exchange, bought another property. He was audited by the California Franchise Tax Board, but his exchange was actually allowed, even though he held title for about a month and a half, because he could prove his intent was to hold for rental purposes, but there was a business reason why he couldn't. So he was allowed to reposition. So it all boils down to intent and what you can show should you get audited. That's really the takeaway from that slide. So that again is the most important slide. So having said that, the holding period is not the deciding factor. It helps. It helps support your position. So whether it's 12 or 18 or 24 months, it really depends. When people ask me, my response is, well, if you're doing a very clean cut transaction, you're not pushing the envelope, 12 months should be fine. If you're pushing the envelope, taking risks, 24 months might be safer. So it really depends on your fact pattern. Next slide, and there's still lots of information out there that's not correct on this one either. There's still a lot of websites and curriculum that says if you sell a condo, you have to buy a condo. If you sell apartments, you have to buy apartments. That is not true. Like kind simply means you are selling real estate, you have to buy real estate. So the only caveat there, like I said before, you have to sell US and buy US property, or sell foreign property and buy foreign property. You can't go between the two. But bottom line is, anything that is considered real property will qualify for 1031 exchange treatment. So you can see the list here. These are all the different types of real estate out there that qualifies, and it includes things you wouldn't even think of: air rights, water rights, mineral rights, certain types of oil and gas investments, fractional ownership like a syndicated tenant and common investment property, or a Delaware statutory trust. All of those are considered like-kind property to each other. You can exchange between all of these and still defer your taxes. Just as important is property that is not considered like-kind. So a primary residence, a vacation home, a second home, anything with a lot of personal use is probably not going to qualify because it's not held for rental, investment, or business use. Now, intent can change. You can change from personal use and convert it to investment property, then it would qualify. This slide gets a little complicated, but it's important. It's one of the most complicated areas in the 1031 exchange world. There's a lot of investors who put together, 2, 3, 5, 10 investors in an LLC or some other type of an entity. Typically today it's an LLC. That creates a partnership. So the LLC, you are members in the LLC, which means you now become partners in a partnership for tax purposes. When you go to sell real estate, you as an individual are not selling real estate. You are just a partner in the partnership. The partnership as an entity is selling the real estate. So in this case, the LLC is selling the real estate. If you get a cash distribution, there's no way to 1031 exchange that because you haven't sold real estate. Now, there are all sorts of ways to fix or address the problem. It depends on all the different partners, all their goals and objectives, but we have to find a way to structure it so you're actually selling real estate as opposed to getting a cash distribution. So if you own real estate in an entity with multiple investors, we need to talk and see what kind of challenges you might have. Now's the time to ask the question, what is your exit strategy? What do you think you're going to do to get out of this real estate down the road? If you think the partnership will sell, you may want to change the structure today so that you can qualify for a 1031 exchange in the future. One way is take the property, deed it out of the entity, deed it into individual names as tenants in common, and then 2 years later, 5 years later, when you sell, each individual can decide what they want to do, what's best for them. Deeding it out today, selling tomorrow is a problem. There's risk with that. So you really need to sit down. We can get on a conference call with you and us, your tax advisor, legal advisor, walk through the issues and come up with the best plan of attack. Just remember, if you own it inside of an entity, you don't own the real estate, the entity owns the real estate. This is a quick ruling that came out from the IRS. It's a revenue procedure. So vacation properties can qualify if you rent it for at least 14 days per year and you limit your personal use to not more than 14 days per year, or 20 or 10% of the number of days that you actually rent the property out. So it's a very positive ruling. There is a way, obviously, to do 1031 exchange on vacation properties. In a lot of cases, people don't want to wait those 24 months. So advice there, you stop using it personally, you rent it as long as you can. The more months you hold it as a rental property, the more tax period you straddle, the safer your transaction will be. Deadlines. When the sale of your property closes, or if you're doing a reverse exchange, the date that your purchase closes triggers a couple deadlines. You've got 45 calendar days to identify what you're going to buy, or in the reverse exchange, you're going to identify what you're going to sell. That's probably the toughest part of the 1031 exchange, is a 45-day period moves very quickly. Look for ways to tie up the property. Maybe you get a buyer to come in and say, I need a long-term closing, I need options to extend. Maybe you find the property you like first, and maybe the seller's willing to cooperate, give a long-term closing, long-term escrow, options to extend. If you could tie up the closing, not actually close, just tie it up until you're ready to close, it could make these things a lot easier. Also, someone had asked about Delaware statutory trust. That's an option as well, to look at a Delaware statutory trust as a primary investment strategy, as a backup strategy, etc. Then after the 45 days to identify, you have an additional 135 days to actually complete the 1031 exchange transaction, for a total of 180 days. It's not 180 plus 45, it's 45 plus 135 for a total of 180 days. Okay, the identification requirement gets complicated as well. Most people use the 3 property rule, so you identify 1, 2, and 3. The reason for that is you identify 3, you really target 1, 2nd and 3rd is backup properties. That usually works great. In today's market, not so much. You identify 3 properties, the one you really want, for some reason you can't acquire it, it falls out of escrow, what have you. The 2nd and 3rd properties are probably long gone. So it's all about timing, all about lining up what you want to purchase and kind of getting all your ducks in a row per se, and then start the closing process. Not always that easy to do, but that's really what your goal needs to be. Get your plan in place and start lining things up. Now, some investors are going to sell one property, a larger asset perhaps, and they want to invest in smaller properties. It's kind of a diversification strategy. So in that case, the 3-property rule may not work well. With the 200% rule, there's no limit on the number of properties. The limit is actually on the total value that you identify. So let's say you sell a property for $5 million, 200% of that is $10 million. You could identify as many properties as you want up to $10 million in total value. It doesn't mean you're going to buy 10 million. It means you're identifying more properties to look at, to choose from. All you have to reinvest is that 5 million. Delaware statutory trusts often have multiple properties inside of the DST, so you're probably going to use the 200% rule. But it's either or. And the 95% exception is really an exception where if you identify more than 3, more than 200%, you're still going to be okay as long as you purchase, actually close on at least 95% of the value that you identified. So having said that, we get a lot of questions about how much do I have to reinvest? And this is probably the third area. First one was qualified use. That's the most confusing area. Then like-kind property, and now probably reinvestment. A lot of people think you have to reinvest your profit, your taxable gain, or your cash, the equity that comes out of your sale. Neither of those are true. It's the top line. It's all about, number one, you have to have the intent to reinvest. After that, you have to make sure that you trade equal or up in value, which means, let's say you sell for $5 million, you are allowed to subtract your routine selling expenses. So your broker's commission, title, escrow, etc. And then with that, you're going to get a net sale price. So if you sell for $5 million, you subtract your routine selling expenses, your net is going to be, I don't know, say 4.7 to 4.8 million. That's the magic number. That's what you have to reinvest. You have to trade equal or up in value based on that 4.7, $4.8 million value. It's not the cash or equity. It's not your profit. It's the top line. So the government's really taken the position that you own this asset worth about net 4.7, 4.8. And as long as you remain fully invested at that level, they let you defer all of the taxes. We'll talk in a minute about partial exchanges or trading down in value. So the two requirements there are trade equal or up in value and reinvest all of your equity. If you pull equity out, it will be taxable. You can always put more cash in, but you can't pull cash out unless you want to pay tax. So partial exchanges, this is one of the things that drives me crazy out there because there's so many brochures and websites that say you have to trade equal or up in value. You have to reinvest all your equity. You have to replace your debt. That's true for the most part because most people want to defer all of their taxes. So you do have to trade equal or up. You do have to reinvest all your equity, and the difference will be the right amount of new debt. Or you could put out-of-pocket cash in and pay all cash for it if you wanted to. But you can trade down in value. You can do a partial 1031 exchange. It does not hurt the 1031 exchange, but you will pay some tax. So a couple of examples, a lot of people are real estate rich, cash poor. So maybe you need some liquidity. You sell for 5 million, maybe you reinvested 4.5 million. You've traded down by about 300,000, 400,000 net. You're going to pay tax on that 300,000 or 400,000 that was not reinvested, but everything else would be tax deferred. Now, as I mentioned early on, always talk to your tax advisor because you may have suspended passive activity losses. You may have a net operating loss carry forward. You may have something else that would partially or fully offset your gain. So you might be able to do a partial 1031 exchange and trigger the gain on a small amount of money, but still not pay tax. So it all depends on your situation. So talk to your tax advisor, find out if you can trade down and pull cash out of the transaction without paying tax. Very important. But the message here is you can trade down in value, you can pull cash out, you will pay taxes, but it doesn't hurt the rest of the 1031 exchange transaction. So we've talked about permissible selling expenses when I was talking about calculating the net sale price. And there's really 3 buckets on a closing statement. One bucket is selling expenses, broker's commission, title, escrow, documentary transfer tax, etc. The other 2 buckets are non-permissible expenses. What's the difference? A permissible expense means you can pay it with net proceeds from the sale and it will not trigger a tax consequence. Non-permissible expenses mean you can still pay it from the proceeds from the sale, but it will trigger a taxable event just for that dollar amount. So the second bucket would be operating expenses, prorated rents, prorated property taxes, HOA fees, anything that's a month-to-month or annual operating expenses is non-permissible because it's not a cost to sell the property. You're just prorating or anteing up what you owe based on your operating expenses. So that's not a cost of sale, it's part of an operating expense. It's deductible as an operating expense, but it's not permitted as a 1031 exchange expense. So you could add up all those operating expenses, put out-of-pocket cash into escrow to offset those, and it would not be taxable. Most people probably just pay it through escrow. They pay a little tax on it. It's not a big deal. Whatever's up to you, whatever you prefer. The third bucket is lender related. So any type of demand statement fee, prorated interest that's still due, late fees, things like that are non-permissible expenses. They're financing expenses. They're not routine selling expenses. So if you pay those through the closing, again, just like operating expenses, it won't hurt the 1031 exchange, but it does trigger a little bit of a tax consequence. Again, you could add those up, put out-of-pocket cash in to offset that, and then you would not pay any tax. So it really kind of depends on what you prefer. So this is a quick list of permissible selling expenses. So you can see these are normal things. It's part of the cost to sell the property, and they are permissible. You would not pay tax if you pay these through closing, and most people do. This is a quick list of non-permissible expenses, and you'll see it's lender-related items or operating items. And again, you could pay it through closing, but it will trigger a slight taxable event because these are non-permissible expenses. Exchanging multiple properties, there's a lot of folks who think you have to sell one and buy one. Not true. You can sell multiple, you can buy multiple. There's all sorts of combinations there. The more properties involved, the more complicated it gets. So just kind of keep that in mind. I think the one that I did, and this is years and years ago, and it was a concurrent 1031 exchange, which is just mind-boggling, but they sold one property and they bought 86 separate replacement properties, all closing on the same day, different states, etc. And that was a rough transaction. But it gives you an idea. There's really no limit. It just gets more complicated. It's more difficult to deal with the identification process, etc. So it can be done. It's more complicated. And this responds to one of the questions that was posted, and that is, can you combine different types of transactions? And yes, sometimes you'll hear people say, oh, no, you don't have just 180 days, you have 360 days, or etc. That's not true. Each exchange, if you're going with the safe harbor, which almost everyone does, each exchange is limited to 180 calendar days. You don't get more than that. You can't apply for an extension or anything like that. But you can combine 1031 exchanges. So for example, let's say you're selling an asset, maybe it's 5 million. You sell that, you go to identify your replacement property, you find your replacement property, the property you found that you really like is worth 10 million. And sorry for the big numbers, I use those because it's just easy for my poor brain to handle the calculations. But in that case, you're selling for 5, you're buying for 10, you have traded way up in value. Now that 1031 exchange qualifies, so it's not a problem. But a lot of times you think, geez, I'm buying $10 million of value. I wish I could sell a second or even a third property to use to pay for that. So if I could sell a total of 10 million and buy 10 million, it's an even exchange, but I don't have time. So you can actually combine a forward 1031 exchange going into a reverse 1031 exchange. So in that example, you're selling for 5 million, you're buying for 10 million. We could take that $10 million asset and split it. We could allocate the first 5 million to wrap up the forward exchange. So you've sold 5 million, you've bought 5 million of that property, 50%. The other 5 million is then used to start a brand new reverse 1031 exchange. Now you have a new 45-day window to identify a second and or third or fourth relinquished property, and you have a new 180-day window. So you probably won't have the full 360 days, but you'll have, an extended time frame to sell another 1 or 2 properties. and that's kind of using a forward reverse. We've done forward reverse, forward reverse. I think that's the worst case we've ever done so far. But you can combine them and just keep on going as long as each one satisfies their 45 and 180-day requirements. So a lot of planning opportunities there in terms of combining different types of 1031 exchanges. Today, we're getting lots and lots of questions about seller carryback financing. The questions are, I'm selling property, buyers can't afford 7%, 8% interest rates, so I'm going to do a seller carryback note. I'm going to charge them 3 or 4 or 5% or what have you to make it easier, and that way I can get the price that I want for the property. Great concept. It does help move property. You may have to do that to get your transaction closed, but it complicates your 1031 exchange. The best way to look at it is when you sell property with a seller carryback note. That seller carryback note is part of your net proceeds. You've sold property, you're getting some cash, you're also getting a seller carryback note. So what do you do with that note? Well, that note has to be used somehow toward the purchase of replacement properties. Otherwise, that part of the note will be considered taxable boot because it was not reinvested. So you can't offset that by getting new debt on your replacement property. This is not considered debt. It's considered a part of your proceeds from the sale of your property, and it has to be used toward the payment of your replacement property. There's ways to do that. We don't have a lot of time to go through the details now, but there's really 5 ways to do it. You're either converting the note to cash, you're assigning the note to somebody else for the payment of your property, or you're selling the note to somebody who then gives you cash so you can close on the exchange. We have a whole webinar just on seller carryback note financing in a 1031 exchange and a whole article on our webpage that goes into a lot of detail on that. So if you're interested, we can send you a link to that, make sure you're good to go. This is one of the areas that it also drives me crazy because people say you have to hold legal title to the relinquished property and the replacement property in exactly the same name, legal name, and that is not correct. It has to be the same taxpayer. That's the most important part. So a couple of examples. The most frequent that I can think of is you're selling property that's held in a LLC. The LLC is a single member LLC. It's a disregarded entity, which means it does not file its own federal tax return. It sells the real estate. It goes to buy the replacement property in the LLC, and the lender says, no, we will not do that. So the lender forces you to buy the property in your individual name, and everybody starts freaking out and saying, oh my God, that won't work for a 1031 exchange. Well, if it's a single member LLC and a disregarded entity, and you're the sole member, you are considered the taxpayer. And over here, if you are buying the property in your individual name, you are the taxpayer. So that does qualify. It's the exact same taxpayer. Same with living trust. If you hold property in a living trust, you go, sell it, you do an exchange, you go to buy replacement property, and the lender says no, which is very common for living trusts. You have to take title in your individual name. As long as that living trust is disregarded, it's going to be treated as you are the same taxpayer. It will qualify for 1031 exchange treatment. So the bottom line is you just talk to your tax advisor and say, here is the scenario. Is that going to be considered the same taxpayer? And typically anything that is a disregarded entity will work if you have to take title in a different way. So just keep that in mind. So single member LLCs that are disregarded entities qualify. Delaware statutory trusts are considered disregarded entities. Land trusts, or sometimes called title holding trusts, are disregarded entities. Living trusts or fully revocable grantor trusts are disregarded entities. So entities can also break up. We talked about this a little bit under the partnership area. If you hold title to property in a multiple member LLC, in a partnership, in a C Corp, in an S Corp, etc., we have to look at the entity. We have to look at the goals and objectives of the individual owners or stockholders or members. And we have to say, okay, how can we change or break up the entity so that you're selling real estate and can do a 1031 exchange? There's a lot of moving parts here, which we don't have time to go into today, but just want to throw that out there so you know that if you own property in an entity like that, you might want to ask the question now, what's your exit strategy? We're almost done, and then we'll take as many questions as you guys want to throw out there at us. Related party issues. This gets complicated. The best way to summarize this, selling to a related party is okay, except you just have to hold it. The related party has to hold it for 2 years. So selling to a related party is okay, 2-year holding period. Buying from a related party when you're doing a 1031 exchange probably will not work. It's Revenue Ruling 2002-83 for your tax advisors to go look at. But in most cases, buying from a related party will not qualify. There are some exceptions. If we can show there's no tax avoidance going on, so one way to do that is the related party does their own 1031 exchange, so they're both tax deferred, that will work. Or if we can show that the related party is paying at least as much taxes as what's being deferred through the 1031 exchange, that will also work. That's complicated, so I said that really fast, so we can always go into go into a phone call and kind of talk about your specific situation. Last slide, and then we'll take questions if you have any. This is one of my favorite tax planning strategies. So I'm going to use a client that we worked with a number of years ago as an example. This client bought property in La Jolla, California. He and his wife owned it for 42 years. They lived in it as their primary residence for 42 years. They were having health issues. They wanted to move back east with their kids, family and kids, et cetera, grandkids. But their capital gain was $8 million after 42 years. If they sold, they would get $500,000 tax-free as a primary residence, but they would get killed on taxes for the $7.5 million in gain left over. The IRS came out with a ruling back in, I want to guess, it's either 2005 or 2008, where they allow you to convert that property to investment property, rent it or hold it as investment property long enough to show intent. That goes back to the intent issue we talked about. And then once you sell, you qualify for both. So what we recommended the client do with their legal and tax advisors is move out, move back east with your kids, your family and grandkids, et cetera. Rent the property for 2 years. That straddles 3 tax periods, very solid proof that you intended to convert it. Then sell it. And you still have 1 more year where you can still say you've lived in it for 2 out of the last 5 years. Make sure you sell and close on the sale before the end of that time frame. And if you do, you can say, I've still lived in it for 2 out of the last 5 years. I get $500,000 tax free. You can take that off the table and do whatever you want to do with it. Or number 2, you can also, or not or, but in number 2, you can also say, I have rented the property now for 2 years, so I now qualify as investment property. I can also do a 1031 exchange transaction. So in their case, they rented it for 2 years, got the $500,000 tax-free. Because they rented it for 2 years, they did a 1031 exchange, and they deferred the taxes on the other $7.5 million into properties that they now get cash flow on while they're living with their family. So kind of a great win-win strategy. It goes into where you can combine all sorts of structures. We talked about combining a forward into a reverse, et cetera. So there's a lot of opportunities here to do that. And with that, that is a quick whirlwind tour on 1031 exchanges. We ran a little bit over there, sorry about that. If there's any follow-up questions, be happy to take those. This is the contact information for the various companies we have. And you could reach out to the business development officer that referred you to the link today to register. They can answer a lot of the questions. And if it's more complicated, they'll get me involved and we can talk about this, whatever the structure or strategy is, and walk you through the process. So with that, I'll just kind of hesitate for a minute and see if there's any follow-up questions. Good question. So we have a couple questions popping in here. One is, if I sell the property in my single member limited liability company that is 100% owned by me, can I buy replacement property with me and my spouse? And the answer is it depends. So certainly if it's a single member LLC and a disregarded entity, then it's treated as if you are the taxpayer. If you're in a community property state, you should have no problem buying with you and your spouse, and that should be fine. You want to check with your tax advisor to make sure that it's going to be considered the same taxpayer for tax purposes. Some states treat that as 2 different taxpayers, so it depends on the state. Community property states almost always work with no problem, but other states do have some challenges in there. We got a question on fees. What are our fees? So good question. Fees depend on the type of 1031 exchange transaction that you're looking at. So 97% of our transaction volume is regular forward 1031 exchanges. So those are, if you sell one property and you buy one property, so it's a standard exchange, 1-for-1, our fee is a flat fee of $1,295, and the $1,295 includes everything. We don't charge transaction fees or wire fees or anything like that. If you sell one and you buy multiple properties, the first purchase is included in that $1,295. Each additional purchase is going to be $300 additional to cover the processing for those additional closings. Let's see, next question is, does it matter if the relinquished property is in California and the replacement property is in DC? California is a community property state, but DC is a non-community property state. So really good question. That goes back to the same answer as before, that you want to talk to your tax advisor and make sure that it's going to be considered the same taxpayer. Now, in most cases, let's say you're a resident of California, which is a community property state, and you're selling California property and you're buying DC property, that should qualify because you are a resident of a community property state, and that DC property should be considered a jointly owned asset and, considered the same taxpayer for tax purposes. If you're a resident of DC and you're selling California property and buying DC property, DC is not a community property state, so that may be an issue. You have to talk to your tax advisor to see what the issue is there. Next question is, if I sell and don't do an exchange, will I have to pay state tax in the state I live in and the state I sell in? Good question. So it's the answer, probably yes, but it depends. In most cases, you're going to pay federal taxes, of course. Then you're going to pay state taxes in which you live in, usually, and you're probably going to have to pay tax in the state that the property is located in. But there's some nuances there. Some states that you purchase in have a threshold. So if the income from the property is below their threshold, you may not have to file or pay tax in that particular state. If the income is above the threshold, you probably would have to file in that state. In the state that you live in, they may also have a reciprocal agreement of some type where if the other state's forgiven, you're forgiven. In California, that's not the case. So in California, where I live, they are going to assess California taxes because they want a piece of the action no matter where the property is located. However, if you also pay tax in another state, California would give you a foreign tax credit for the amount of tax you pay in the other states. You're kind of paying California, which is the maximum tax. Part of it's paid to California and part of it would be paid to the state that you live in. Generally, you're not going to pay double or both taxes, but it depends on the state, on both states, just to make sure. Let's see, next question is, if I pass to my wife the 1031 property upon my death, and when she passes, our daughters inherit that 1031 property, does the step up in basis take place twice? Generally, yes. Most importantly, you want to talk to your tax advisor to make sure that you're holding title in the best manner possible so that you will absolutely get that double step up. But if you are holding title properly and you've got everything set up and in place, then when you pass and you leave it to your wife, she will get a step up in cost basis. Then from there, she would only be responsible for gain after the date of death. And then once she passes, if she continues to own the property or she continues 1031 exchange, whichever, when she passes and leaves the property to her kids, or your kids, your joint kids, but as surviving kids, they will also get a step up in cost basis, et cetera. So yes, they both should get it, but check with your tax advisor to make sure you own everything so that it does qualify there. Question on reverse 1031 exchanges. I'm going to paraphrase this, and also in terms of reverse exchanges financing. So I'll dig a little deeper there. Typically, the most beneficial structure for you as the client is for us to acquire and hold legal title to the replacement property that you're purchasing. So we set up an LLC just for you. That LLC is used to acquire and hold title to that new property. It's what the IRS calls parking title to the property. The difficulty there is we're holding title. If there's a lender involved, the lender is going to say, wait a minute, I'm lending money to you as the buyer and the borrower, but this company over here is holding title to the property. That's why they're not real comfortable with that. So in a perfect world, there are lenders who will do it. Usually it's going to be a portfolio lender who will lend to us because they're going to keep the loan in their portfolio. They're not going to try to package it and sell it to an investor pool. They'll probably want you to guarantee the debt, and we'll sign the promissory note and the deed of trust or mortgage as long as it's non-recourse to us. So that's critical. It has to be non-recourse to us. Some lenders will just not lend to a reverse exchange situation. Some lenders will not lend to an LLC, which is what we're using to hold legal title. And some lenders will not do any non-recourse lending, period, even if it makes sense, like in this case. So best case there is we jump on a call with you and your lender, we walk them through the process, and we make sure they're comfortable with that. If not, we want them to say no right away so you can go find a different solution. Let's see, next question is, can you describe a typical exit strategy to get out of a 12-unit portfolio of individual units so my client can retire? Good question. Certainly, let's see, it's a 12-unit portfolio. So I don't know if that's a multifamily with 12 units, so it's one property, or if that's 12 separate properties. If it's 12 separate properties, it certainly gets more complicated because you have 12 sales. With 12 sales, it's all about timing. So when you start to market those, when the first one closes, that starts the first 1031 exchange. What I'd recommend is you start with one 1031 exchange. You try to get all 12 to close really close together. So it's one 1031 exchange with 12 sales. And then they could buy into something that is easier for them to manage based on their retirement goals. So that could be something like a Delaware statutory trust where all the property management and all the issues are handled by the trustee of the trust, and they just get a distribution. It could be a net lease properties where they're a little bit involved, but for the most part, they don't have to do any work. So there are some passive investment options that you can look at. There's also some like solar investment options you could look at where there's no investment management headaches. So there are different things they could look at. The trick there, though, is 12 units. If they're 12 separate properties, getting them sold in escrow and closed relatively close together could be problematic. So it may end up being that you split it into 2 or 3 exchanges grouped by their closing dates, and then you just kind of go with the flow and see what happens. It could also be that you find one buyer. If it's one apartment complex or if it's 12 separate units, find one buyer that acquires all of them with one closing date. So it's really one buyer, one seller, one closing, makes it a lot easier to manage, but you'll probably end up selling for a lower market value as a convenience fee, if you will. Then you could do the 1031 exchange into whatever makes sense for them. But we're seeing a lot of folks who are going into retirement or are already in retirement, and they don't want the property management headache. So probably the most common structure today is the Delaware statutory trust, and second would be net lease properties, et cetera. So if that answers your question, great. If not, if you want to post a follow-up question, that'd be perfect. Next question is, if I own a partnership LLC, will my heirs receive a step up in cost basis? Yes, but they're going to receive a step up in cost basis in the partnership interest, not in the real estate. Because remember, what you own is a partnership interest in the LLC. And so the step up is in your investment, which is your partnership interest. The partnership as an entity actually owns the real estate. So the real estate itself will not get a step up in cost basis, but the partnership interest will. Now, in some cases, there are exceptions to that. So that's where you want to sit down with your tax advisor and do some proactive planning and say, look, I know this is going to be a step up in my partnership interest. Are there any other objectives or anything else we can do to address that issue? The other partners might be interested in the same question too, so they might be willing to restructure the partnership based on the answers to those questions. And it looks like that is the last question so far. I'll wait a few more minutes, see if there's any other follow-up. Good. Another question is, my realtor tells me that I have to put 1031 exchange language in my contract. Good question. So pre-regulations, and that means pre-1990, nobody really knew how to structure the 1031 exchange. So attorneys would advise clients to put language in the contract that integrates the whole thing into one integrated transaction, which talks about cooperation clause, buyer and seller working together, everything's contingent upon the other, etc. Once the regulations came out in 1990, 1991, they allowed a lot of things, including you don't need to have language in the contract. Now, certain states have disclosure requirements, so that's a different answer, different issue. But purely from a 1031 exchange issue, you don't have to have any language in the contract that says I'm doing a 1031 exchange. I would think it's advisable to have cooperation clause where on the sales side, you say buyer agrees to cooperate at no additional cost or liability with seller's 1031 exchange. You can even add by doing the following, blah, blah, blah. That way they can't back out. We don't see a whole lot of buyers refusing to sign documents or backing out, but it does happen occasionally. Probably more frequently as it's a government agency as a buyer and they refuse to sign the 1031 exchange documents. So putting language in there that they will cooperate can certainly take that out. Other questions? Good questions, you guys. Okay, it looks like that's the end of the questions. I'll just kind of hang out just in case there's another one in another minute or so. Once we're done, you will get an email. There'll be a link so you can listen to the recorded webinar again if you want to. There's also links to some of the documents, so that includes the guidebook if you want a copy of that as well. You're always welcome to reach back out to the business development officer you've been working with. They can hook you up with a conference call with me if it's a complicated topic. We're always available to brainstorm, answer questions, etc. We're not afraid to do that. So let us know if we can be of any help. Okay, that looks like no more questions. So thank you everyone for joining us today. Hope it was beneficial for you. Again, these are complicated topics. So anytime we can help brainstorm, be happy to do that. Just reach out to us and let us know how we can help. Again, thank you for joining us and we look forward to working with you. Take care, everybody. Bye-bye.